is IFRS 5, non-current assets held for sale and discontinued operations. So there are two things. One is non-current asset held for sale and one is discontinued operation. Treatment is more or less the same. What is the, how to say, the philosophy behind this? When you've got assets, business has to recover the value of asset. I mean, when you purchase something, you purchase a non-current asset. For example, you purchase some machinery, you purchase a car, you purchase a vehicle for $20,000. Why do shareholders spend $20,000? I mean, when you give your money in some business, you always expect that your money should come back to you along with some profit. Okay, this is the only reason why you took the money out from your bank and put into your business. You never put money into business with this, intention that it is lost, it will never come back. You expect your money back. So whenever you make investment, the thing which comes to your mind is when I will get it back and how much profit I will make. That's the only reason you are putting money in business. And then, so it means that you have to recover the value of assets. So whatever money you have put in, you have to recover that. And how do you recover? You have two ways of recovering the asset value. One is that you recover by using the asset and probably over a long period. And this is when you call it non-current asset, because non-current asset is an asset from which you recover your value by using it over a long period of time. For example, I spent $20,000, I purchased a car. And my objective was to use this car as rent a car. I will give it to my clients on rent. I know that it will not earn me 20,000 in 1 year, but I know that in 3 years time, I will get back my money. So I am recovering my amount by using the asset. And second is that when you decide that recover by selling the asset, this is usually when you call it your inventory. I'm using the word usually. You call it inventory. For example, you purchase a car and for 20,000, you brought the car from Dubai or some other country, you import it into your country for $20,000. And what do you want to do? You want to sell it. You want to get back your 20,000 plus $2,000 profit. You are looking for customer. You find a customer, you give him the car for 22 and you take out your money. So your intention, I'm using the word intention. Your intention was to recover your value by selling the asset. In this case, it is called inventory. So mostly with your non-current assets, our intention is to recover our amount by using the asset and probably over a longer period of time. If we sell it within 1 year, it becomes inventory. Now, but it is also possible that at some point in time, you may decide to sell the asset. So you got a car, you were using it for rent a car, you thought that you will use it for 3, 4, 5 years, but after 1 year or maybe after 2 years, you decide that I do not need this car. So you are planning to sell it. You said, I'm not going to use it. So it has some book value. Initially, it was 20,000. When you used it for 3 years, you depreciated it. The net book value of this vehicle in your balance sheet is already 11,000. Okay, so it was 20,000. It was 20,000, and then you depreciated something like 9,000. And today, the net book value in your books is 11,000. And you want this 11,000. 9 you already have depreciated. 11 you want further. You said, I'm going to sell the asset, and I want to recover by selling. So you are changing your intention, you are changing your plan, you are changing your course. You say, I'm going to recover my asset. I'm going to recover my amount, my value, my investment by selling the asset. This is where the topic comes in. You call it non-current assets held for sale. So this was a non-current asset initially. Usually we don't sell non-current asset. Usually we only sell inventories. We sell inventories. But here what is happening, that a non-current asset, we are planning to sell. We are planning to sell the non-current asset. Okay. So you call it non-current asset held for sale. Now, as soon as this non-current asset, it becomes available for sale, you change its classification. Now it is no more IAS 16. Previously, it was IAS 16. My intention was to use it into the business and generate economic benefit over a longer period of time in future. Now I'm not going to use it in the business. I just want to sell it and get the money out of that. So now it is no more a non-current asset. You start treating it under IFRS 5, which is called non-current asset held for sale. And your valuation method will change. Previously, you were talking about the economic value of the asset or present value of the asset. You will just change all those stuff. So let's start the chapter. Objective. IFRS 5, it deals with two separate topics: non-current assets held for sale and discontinued operation. IFRS 5 requires assets which management have decided to sell to be measured and disclosed separately from other non-current assets. So in your balance sheet, you have PPE, then probably you have intangible assets, you have goodwill or whatever other things, and then investments, and then you show separately non-current assets held for sale. You show them separately, so that the users of the financial statements should see that business is selling how much assets or which assets, and you need to give a lot of disclosures. You know what I always say, because I worked 24 years in my life, and I was working, my last position was head of the finance, like CFO. And I know I had a lot of authority, but my authority was restricted. You know what? I could buy the asset for 500,000. I had my limit was 500,000. Until 500,000, I could take decision. More than that, I need the board. But until 500,000, I can decide with the CEO. CEO will take the decision. I will make approval. Job is done. We don't need the board. 500,000 we could manage. But I could not sell the asset even it is 5,000. Buying the asset is not a problem. When my shareholders, they came in, they said, why did you buy these vehicles? I said, listen, we needed this thing. We made this calculations. We purchased this asset because we needed in the business this asset. And this is how the asset is bringing in the value. They will say, okay, no problem. They will be happy. But if the shareholder comes in and says, there was one vehicle here, where is that? I say, I sold it. And who am I to sell the asset? Asset does not belong to me. It's not my asset, okay? And it's not even the management's asset. The asset belongs to the company. And how can we sell someone's asset, company's asset? So selling the asset, it is more technical. It involves more legal complications. A lot of documentation is required. A lot of, you have to save yourself. You have to save and protect, and you have to do a lot of documentation when you are selling the asset of the business. You can just imagine you've got a manager, you have a small shop. You have a small shop, and on the counter, there is one computer. Next day you will come in, you have a flower shop, a small flower shop, you come in and you see that your manager has bought one printer. You ask him, why did you buy the printer? And he said, I needed printer because customers were asking invoices. So I gave $100, I got a printer. And you say, okay, no problem. Good. You did a good job. But if you go another day and you see that on that reception counter, whatever, sale counter, computer is missing. You ask him, where is the computer? And he said, I sold the computer because I thought we don't need it. And you would ask him, who are you to sell the computer? Did you take permission from me? So selling the asset is definitely a little bit tricky thing. I mean, this I'm just telling you so that for practical life, you should understand. And you need to give a lot of disclosures. So IFRS 5 requires assets which management have decided to sell to be measured and disclosed separately from other non-current assets, separately, so that nothing is being hidden. Shareholders and other users of financial statement, they should understand. Because what will happen? Shareholders will, or the users will believe that there is some asset, but then after some time, the asset is missing. They always thought asset is there, but then they see asset is not there. So you need to be careful on that. Okay, it also requires separate disclosures of the results of the components to the business, which will not recur in future years. So when you will sell this asset, what will happen to the results? Because these assets definitely will bring in some money. So when you sell the asset, how it is going to impact the business in current period and in the future years. As such, it aims to enhance the ability of users to make predictions about the future profitability, cash flows, and financial position of an entity. You know that your non-current assets are earning assets. Your current assets are not earning assets. Our non-current assets are earning assets. The success of the business, it depends on the quality of assets. The more assets you have, the more profitable you can become. And you are making money by using the assets. So when you are selling some part of the asset, you cannot assume that nothing will happen to the business. You have to justify why these assets are sold. Maybe they are old. We have to bring the new ones, or probably any other reasons. So good disclosures are needed. So assets held for sale. Non-current assets are held for sale if their carrying amount will be recovered through the sale of the non-current asset rather than through the assets continuing use in business. This is what I was explaining you in the beginning, that usually we recover the amount by using it. But here we say that they are held for sale if their carrying amount will be recovered through by sale of the non-current asset. We are recovering the amount by selling it. In order to be classified as held for sale, the following criteria must be met. So when you classify an asset, you've got a truck, okay? You've got a truck and you want to sell it. So they have given you two criteria. Number one, the asset must be available immediate sale in its present condition. For example, if I have got a truck which I want to sell, but at the same time, I have one contract with my client for this particular truck for the next 6 months. So the client has bound me with a contract for this truck. It cannot be classified for held for sale, because in order to be classified as held for sale, it should be immediately available for sale. If a customer comes tomorrow, I should be able to give it. And the sale must be highly probable. And the sale must be highly probable that you know that you will be able to sell it. Where an asset satisfies these criteria, it will be remeasured. You will remeasure it again, because before it was in your balance sheet, and probably in your balance sheet, you were showing it at the cost model. The cost model means, remember, cost model means 20,000. The vehicle cost minus 3,000 depreciation gives you 17. In second year, 3,000 depreciation gives you 14. So before, probably you were measuring it at 14,000, which was the net book value. But now you are going to sell it. So this is no more relevant, because net book value is company-based estimate. It is company-based estimate. Now you are selling it. You need to have a market-based estimate. You need to have its fair value, okay? How much it is possible to sell in the market. And by the way, there are a few more criteria. They just mentioned two of them, but you should remember a few more criteria as well. Let me write them down here. Okay. The other criteria which I will focus here, I would say that the business is doing reasonable effort to sell the asset. So it is not like you only classify it on the balance sheet and you do not try to sell it. You also need to show that the business is doing efforts to sell the asset. the asking price is comparable or below the market price. So the price which I'm asking for the asset, this should be the price at which it could be sold. You know why they put so much strict criteria? I tell you. Why do they say so strict criteria? The reason is that this is what I'm going to write down. I say stop charging depreciation. This is where you can manipulate. This is where you can manipulate. It means that when you classify an asset as non-current asset held for sale under IFRS 5, what you should do, you should revalue the asset. So before it was 20,000, 14,000, you say no, market, we think that we can only sell it for 12,000, or maybe you can make it for 15,000, whatever. You remeasure it and you transfer it to another account, which is called your disposal account, where you think that this is for disposal, and you stop calculating depreciation. You still will be using the asset. They don't say that, it says that it is available for sale, but it does not stop you from selling the from using the asset. So you keep on using the asset, and it is a truck. I give it on rent every day, and it brings money, and the money is added to my income statement on daily basis, but there will be no depreciation. So the truck will be used under this condition. For 3 months, it has been kept into this bracket of non-current assets held for sale. I will use it for 3 months. I will earn the revenue, but I will not charge depreciation. IFRS allows that. Stop charging depreciation, but keep on using the asset if you want to. Okay. So that definitely is a very, how to say, somehow an attractive proposition, that I'm getting the revenue and I'm not charging the depreciation. So my income, my profit in the income statement will look good, because expense is not going there and revenue was going there. But then they put a condition that if you really want to do this thing, asking price should be comparable, business is doing reasonable effort, it is highly probable that the sale will take place, and it is immediate available for sale. And then when you will sell it for, you remeasured at 12, and then probably you will sell it for 11, you will make a loss on the sale of non-current asset. Or maybe you sell it for 13, you will make a gain on the sale of non-current asset. And by the way, when you first reduced it from 14 to 12, when you remeasured it in the balance sheet, it was 14, you measured it at 12. So there is a $2,000 loss. This loss straight goes to your P&L. This goes, the remeasurement thing. And then when you will sell it, you will treat it separately. Now, what happens? For some reason, it is possible that after some time, after 3 months, 4 months, 5 months, 6 months, you decide that I'm not selling the asset. You know why I'm not selling the asset? Probably I'm not able to find a good customer. So instead of selling it on loss, let's use it. One reason. Second reason, maybe you got some new contract and your business plan changes, and you think that you need this asset because you've got some huge contract. So now you are trying to going back. So before the asset was in IAS 16, and you took it here in IFRS 5. And when you classify it into IFRS 5, you stop charging depreciation, because depreciation is charged on non-current assets. Depreciation is charged under IAS 16. Asset is no more a non-current asset. Asset is no more IAS 16. It is like inventory for you. It is like inventory for you now. You are selling it, and inventories we don't depreciate. So you stop charging depreciation for 6 months. So 6 months, no depreciation. Okay. 6 months, no depreciation. But then what happened? After 6 months, you decide that I will again transfer it to IAS 16. Okay, I'm not selling it. I will keep on using it. So this depreciation, which you did not charge, you have to charge it now. So then whenever you decide to transfer it back to your IAS 16, then all the depreciation which you did not calculate in the last 6 months, you will calculate it and post it to your P&L. This is the story of non-current asset held for sale. So measure the asset in accordance with the applicable IFRS. For example, property, plant, and equipment had IAS 16. Classify as held for sale at lower of carrying amount or fair value. So this is where you do like book value or the market value, whichever is lower. Do not provide any further depreciation on the asset. Disclose separately under non-current assets on the face of the financial statement. Please pay attention. The word is face of the financial statement. What do you mean by face? Face means that on the balance sheet itself, so that people can read. There are few things which you do not provide on the face. Like if you talk about accumulated depreciation, do you see accumulated depreciation on your balance sheet? The answer is no. Accumulated depreciation you can only see in the notes, because you have cost in your trial balance. You have accumulated depreciation. You may subtract them. For example, your cost was 100. Your accumulated depreciation is 40. So on the balance sheet, you write down the asset as 60. So on balance sheet, you do not see accumulated depreciation. It is not shown on the face of the balance sheet. So when you see the balance sheet, you don't see the accumulated depreciation. It is given somewhere at the back in the notes. You want to read, go check there. But this one must be on the face of the financial statement. You cannot put a disclosure note for that. You have to put it on the face of the balance sheet. And now there is some question. You will do that question later. It's a very simple, show the required accounting treatment for the asset. And we go there. Then you have discontinued operations. Now discontinued operation is a little bit bigger thing than the asset, because asset was probably one vehicle. It was probably one building. It was maybe one piece of machinery or equipment. But here you've got discontinued operation, where it means a collection of asset which makes one unit of the business. A discontinued operation is a component of an entity that has either been disposed of or is classified as held for sale, and either represent a separate major line of business or geographical area of operations. So discontinued operations, like you stop operating in one country, you say we are going out of Georgia or we are going out of Qatar. So that is a discontinued operation because you stop there. It's not about one asset. It is a part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations, or is a subsidiary acquired exclusively with a view to sale. It is also possible, discontinued operation, that you acquire some subsidiary exclusively with a view to resale. So discontinued operation is like a group of assets. It's a line of business complete. And here you use the word component of an entity. So what is component of an entity? Note that a component of an entity is one whose operations and cash flows can be clearly distinguished operationally and for financial reporting purposes. If you can find out, we call it segment reporting also. We call it business segments. We will do that standard also. So a component of an entity is like any part of the business for which you have separate cash inflows and outflows. For example, you are a bank, and within your bank, you provide different products. You provide corporate loans, you provide consumer loans, you provide credit card, you provide, I don't know, car financing, you provide house financing. And then at some point in time, you feel that, we want to stop this car financing thing. We don't want to engage in car financing anymore. So that's a component of an entity, because car financing has separate cash flows, because you know that you have, 20 people working in car financing, 5 people are for the credit officers, then there was supervisor, there was a manager, and there was some accountant. So there was a team which was monitoring this car financing, and car financing will have its revenues different than the other, your banking operations. So if I talk about car financing of any bank, I can find out their cash inflows and their cash outflows, and therefore I can call it as a separate component of an entity. Imagine you have a supermarket. In your supermarket, you have fruits, you have vegetables, you have grocery, and you have meat. At some point in time, you decide that I just want to stop the meat thing. Now, it's a big thing. I mean, I don't imagine a small supermarket where there is one small area of meat. Probably there is a big butchery behind that. There are 5 or 10 people who work in the meat section. And it has got its own expenses, like 5 people working in the meat section or 10 people working in the meat section, and then the sale of meat. So you can identify its cash flows. You can call it a component of an entity. But if you decide that I will stop the sale of Coca-Cola in my shop, that's not a separate, a good example of a separate component. So disposal and discontinued operations is an example of Vodafone. You can read it. The slides will be available to you. It's India Bharti Airtel Limited. So it's a history, it's an example, and it has been taken from the website. The link is already given, so you can read it. It's a real life example from Vodafone operations, which they stopped. So it says, I'll just read the first line. On 9th May 2007, and in conjunction with the acquisition of Vodafone SR, the group entered into a share sale and purchase agreement, in which a Bharti Group company irrevocably agreed to purchase the group's 5.6% direct shareholding in Bharti Airtel Limited. During the year ended 31st March 2008, the group received £654 million in cash consideration for 4.99% of such shareholding and recognized a net gain on disposal of 250 million, reported in non-operating income and expense. The group's remaining 0.6% direct shareholding was transferred in April 2008 for cash consideration of 87 million. So this is actually a discontinued operation because it said that sale and purchase agreement of shares. So you are buying the shares and you are selling them. So you have an agreement for buying the shares and you have an agreement for selling at the same time. So it's discontinued operations. And then Japan, Vodafone, KH, example, etc. These are income statement. You show them separately. So what you do here, you show it in income statement separately. If you pay attention here, so loss for the year. So this discontinued thing, you show it separately so that the shareholders or the users of the financial statement, they should understand that this is the main activity of the business, but this is something which is coming in from a discontinued operation. And it is making a loss. And that's why I'm, probably I'm selling it. If it has been a very profitable business and then you are selling it, it may raise questions, taxation related to the performance of the discontinued operations. So you show it separately. Taxation related to the classification of the discontinued operations. So this is actually called segment reporting. You call it segment reporting. It is also a separate standard, segment reporting, in which you present the performance of a segment separately. So that's all with this chapter. Disclosures are required on the face of the statement of profit or loss and other comprehensive income. A single amount comprising the total of the post-tax profit or loss of the discontinued operation and the post-tax gain or loss recognized on the remeasurement to the fair value. So within your statement of comprehensive income, if you have some discontinued operation, any gain or losses or any profits or losses, you should be showing them separately. That's also for the transparency of your reporting.